Good afternoon and welcome to GrainTV. Today's December 30th, 2011. I'm Logan Burgess. To my right is my good friend Cody Bills. Cody, really another big week here in the grain complex. We saw corn up 22, soybeans up 29, Chicago wheat up 25 on the week. Where does that leave us as far as a technical landscape? Take a look here at March corn. You can see early in the week we really powered through our 50-day moving average, and at this point we're really bumping our heads up against that 650 level. We expect that to provide some resistance here moving forward, but kind of an overarching technical bearish indicator that we saw was the 100-day moving average dip below the 200-day moving average on this March corn contract. It's the first time we've seen that, and technicians are really going to be looking at this as a bearish long-term indicator. Kind of the same story when it comes to soybeans. You can see that we did power through our 50-day moving average on the soybean contract, but we're still trading well below our 100 and 200-day moving averages. You know, it's really been a weather-driven market in the last couple weeks here, Cody. Another little piece of fundamental news, though, came out this morning with regards to export sales. Where are we sitting when it comes to exports?
Weekly exports were generally supportive of the bullish price move we've seen all week. Corn was the only one to disappoint, with over 100,000 million bushels below what the market expected to see. However, beans doubled what expectations were, coming in at 662,000 metric tons. Wheat also beat expectations, coming in at 431,000 metric tons, all adding to the bullish sentiment going forward. Take a look at where we stand in terms of the whole marketing year to date. We're at week 16, and we're 68 million bushels for corn ahead of pace. However, the weak export sales that we saw this week helped move us 13 million bushels lower than where we were last week. If you take a look at the chart, the blue bars are actual export sales recorded, and the red are expected, taking into account seasonality. You can see from week 8 on, we've continued to disappoint in terms of export sales. If you look at the corn export sales and where we were in terms of week 8, you can see we went from 130 million bushels ahead of pace, now only 68 million bushels ahead of pace. I can only imagine that this rally in the corn market is going to continue to hurt export sales going forward. It's likely this trend will continue. If you take a look at beans, though, it's a slightly different story. We're 51 million bushels behind pace of where we need to be at this time to meet USDA expectations. We actually improved our position by 1 million bushels, or 1 million bushel this week. If you look at the chart, you can see we lost a lot of sales early on during harvest when we should have been making sales. We lost them to South America just due to their competitiveness in terms of price. I can only imagine, like I said, in terms of corn, that these high prices for beans are going to continue to put, the high prices, the rally that we've seen is going to continue to put pressure on export sales going forward.
Yeah, Cody, kind of a mixed bag as far as export sales we saw come out this morning. Looking into 2012, where are you seeing this market headed?
Well, you know, I've never been one to predict South American weather. It is a weather market, and I just wouldn't gamble on it. What I do know, though, is that we did see a rally going into the new year on light volume. We saw open interest decline. We have weak export sales. Open interest declining, to me, tells me that we saw more short covering than longs adding to their position. All in all, I think that once we get into the new year and we see a return of normal volume to the market, there's a good chance we take some gains off the table. However, if South America starts burning up even more than it already is, all bets are off. We'd be moving higher.
Yeah, Cody, I really do agree with you that this rally that we've seen in the last couple of weeks did lack conviction for the reasons you pointed out there. Diminishing open interest, low volume. You know, I really think that a lot of people have kind of forgotten about the relative strength in the dollar index here, too, that we've seen recently. You know, today we really held off going below that 80 level, but with regards to the European Union, they're far from out of the woods when it comes to the value of the euro. That's going to help the dollar remain a strong, very competitive world currency. And, you know, that's not going to help out U.S. export sales moving forward. You know, if I'm a producer right now, I think I'm going to be selling into this rally. Are you in that same camp?
Yeah, I would agree. I mean, I'm not one to bet on the weather, like you said, or like I said earlier. So, yeah, I would be making some sales here, and then possibly re-owning with an option if this thing absolutely explodes to the upside, which, you know, if you get considerable more dryness, you don't get any sort of precipitation down there, we could just rock it to the upside.
Right. Well, we'll keep you posted on that moving into the new year here. This is our last show for 2011. It's been a good year. Everyone have a good, safe New Year's weekend out there, and we'll see you next Tuesday.
Have a good one.